commentary coming through on, the OMCs. But you've got the Nifty, which is starting at about 22,200. We're about 40 points higher on the Sensex and about 5 points higher on the Nifty at this point in time. But I think we can straight away look at what's moving, and I think we should sort of pay attention to what's moving, which is Shriram Finance. I think the stock should come up on your screen without sort of any delay. It's starting about 1.5% higher. So it's not a sort of big reversal as the pre-open initially was indicating, but it is higher nevertheless. Look at Vedanta, which is coming up with about a 2.5% pop. That's the other one that we've been talking about since the morning. Nigel has been highlighting it. You've got more names like Mazgaon Dock, which are starting about 4% higher. Straight off the bat, CMS Info is another name that we highlighted with a 4% gain. And there are names like Cochin Shipyard, which are up about 3% or so as well. So it's a pretty vibrant screen which is coming through. And the big reaction, of course, it's not a big reaction stock-wise, but significant news, and the reaction is on your screen. 3% lower on Vodafone Idea. So Indus Tower is the other one, which is down about 1%. These are the two largest volume-traded stocks which are coming through. There was, of course, negative news flow for Patanjali as well, and Patanjali is down about 3.5%, 1570 or so coming through there at this point in time. But 7 points, so it's a quiet start as far as the Nifty is concerned. And I think we've got the Bank Nifty, which is starting in a quietish kind of way, 0.15%. That is about 68 points in the green, guys.
Absolutely. On Patanjali, just worth keeping in mind that is a different company. Though, of course, it has a sentiment impact on the listed entity as well. Same group, yeah. But the court issues are with the entity that produces those medicines. And that's where the statements came in from the Apex Court. Back to the large cap screen, Bharti Airtel is reacting really well. So the commentary coming in from Mr. Mittal himself, that seems to be rubbing off well on the stock. About focusing on the core business, turning into a digital entity, focusing on payments. The market likes the sound of that. Tata Consumer is showing up some green, 0.5% up, Hindalco, but it's getting very, very quiet on the Nifty otherwise. Tata Consumer, HUL, two names from the FMCG space that I can spot. Little bit of a, can't even call it buying. SBI has got a marginal green tinge. Infosys, but it's just, Nifty slips into red because I can't spot any of the winners on the upside. So let's look at the losers. What is pulling the index down this morning? There's some selling in a couple of auto names like M&M and Bajaj Auto. TCS is reversing some of its gain from yesterday. You have Apollo Hospitals, that is the weakest stock on the Nifty, down 1.5%. So again, it's not very clear in terms of trends. Little all over the place, but blinking green and red. Very quiet start, and frankly quite directionless as we look at the morning.
Well, that's right. A few big volume movers today. BGR Energy, that's coming as one of the top volume movers on the downside. That's down close to around 8% as we speak. Jaiprakash Associates as well is slam dunk. It's down close to around 5%, and I think it's in lower circuit as we speak. India Bulls Real Estate, that's the other stock that has been moving quite well, but today it's one of the top volume buzzers on the downside. On the flip side, let's see stocks that are doing well. CMS Info Systems, well, that one is moving up in style. A lot of big investors coming in there. And now that overhang, I recall a year or so ago, the promoter entity had close to around 40-45% stake. And gradually that's coming down. And in fact, now the P is totally out. So that's why that stock has bounced up. Kochi Shipyard is another one that's up 3.5%. And Railtel, wow, that one's moving pretty well. Vedanta as well, the market likes what the management had to say. Delivery is going to be crucial, but for now, the street has given a thumbs up. So, flattish to mildly positive start is what we can see.
No, absolutely. But the market breadth is pretty positive. So let's hope that stays like that. Yesterday, by the way, while the Nifty did well, the mid and the small cap indices took it really slow. There was not very much which happened there. We've got 1,300 stocks which are higher, and you've got just about 600 stocks which are lower in trade. Just a few more names before we kind of welcome in our market master today. PB Fintech has had a pretty good week so far. I think it's up about, for the week, PB Fintech is up 13%, including today's 2% odd pop. So this is, just the third day into the week, and 13%, not bad at all. Of course, the big move happened on Monday. CDSL is up about 2.5%. A few other names which we have not mentioned, 1960 or so. There is KEC, which is up about 4.5%. It's coming at about 729. KNR Construction is coming with a 2% pop. Chennai Petro. Now these names are, they move big. Chennai Petro is up about 4%. I can't spot MRPL anywhere yet. Torrent Power is up about 2%. 1174 on Torrent Power. And look at something like Dreamfolks. Dreamfolks is up 6% at this point in time. Gensol Engineering, I mean, that huge outperformer, 4% higher on Gensol at this stage. So this is, I mean, you know, a bit more as far as a color on the broader market gainers list is concerned. And by the way, you know, on the downside, now Union Bank is the top volume-led loser with a 3% knock. So it's at about 142 on Union Bank. And Varun Beverages is coming up with pretty sharp volumes. It's down just under 2%, but volumes are picking up on Varun Beverages as well. And Paytm is showing some red after, you know, I think, you know, over the last 4 or 5 days, it's kind of seen green in a significant way. It's bounced 100 odd rupees from the lows. It's starting, I think, about 1.8, 1.9% lower. So maybe a little bit of profit booking here. There is Thermax, which is down 2%. And there is New India Assurance and a few others which are down as well. I think we have Gautam Shah with us. He's founder and chief strategist at Goldilocks Premium Research. Gautam, great to have you with us here on the program. Appreciate your time. Thanks very much. How's the market looking to you, Gautam? You know, this is just, the markets, I guess, climb a wall of worry, and that's what they've been doing. You know, a lot of people, and not just sort of market participants, but because everyone is, of course, fixated with what's happening in the market. I've heard corporates asking the question, you know, is the market's due for a pullback, right? Because many can't. I mean, we heard, I'm sure you heard what the Whirlpool global CEO sort of explained, how he explained the decision to sell some stake here in India. Corporates, and it is not just Whirlpool, but we've heard it from so many that maybe we're due for a pullback. With the market, it does the opposite. What your sense from here, Gautam?
Good morning, Prashant. Well, you know, logically, markets top out on greed and not fear. And I think there has been a lot of concern and fear consistently in the last 6 to 8 weeks. Just because a market is stalling doesn't mean that it's stopping. I think the bigger concern for a lot of people is that the Nifty has gone nowhere in the last 6 weeks. We started the year at 21,700, and as we speak, we are at 22,200. So actually 7 weeks have passed, and the Nifty has actually just appreciated 2%. In this very period, the market has seen a brilliant rotational internal correction, because if you look at the breadth data, only 60% of the stocks in the NSE 500 are trading above the 50-day moving average. So it just goes to show that what was overbought, what had to correct has already corrected, but it's really not reflecting on the price action and the headline indices. I think the setup is still quite solid. We are past earnings, we are past you know, all other global developments, and I do believe that the market can build up on the gains. And this last 6 weeks is actually a nice consolidation or a higher platform for greater upside. So till we are above levels of 21,870 and 21,500, which I think are important supports, I think the trajectory is still up. The pace is still questionable. I don't think the market is going to run away from here, because you're looking at numbers of 22,500, 22,800. But as I've been maintaining all along, this is a market where you need to be in the right sectors and right themes. And till the market trajectory is up, I think there is more upside. And also from a valuations perspective, there is so much talk about markets being overvalued. I mean, at a 22 half PE on the Nifty and at a 24 PE on the NSE 500 index, there is no way that this market is overly valued.
Okay, that's saying it as you see it. Quite emphatic there, Gautam. Hi. Good morning. It's true, you know, when the money comes in, all the valuation talk for that time at least gets pushed to the side of the table. We've seen that, right? So since you believe that the trend is still up, the question is on leadership, right? And the last couple of weeks, we don't have any clear answers. It's not banks. You know, IT looks like it's the leader one day, then there's pharma. There's just too much rotation going on. So are you able to pick any trends in terms of what or who will take this market higher from here?
Well, I think it's been pretty clear that Reliance Industries, which is the big boy and the big heavyweight in the Nifty, has been super strong, and it's at the doors of the levels of 3,000. So that's been one stock that's kept the market higher. And the IT index, despite the range-bound activity of the last 10-15 days, it continues to be super strong. In fact, it's at the doors of the lifetime highs of 39,400. So I do believe that the leadership will come from the IT index and from Reliance Industries, where I'm looking at significant upside even from current levels. And if both these segments of the Nifty do well, which is our view, then I think the market should be safe. even the bank Nifty, I think we've come to a point where HDFC Bank seems to have stabilized around the level of 1400, which is great. And the chances of some pullback in HDFC Bank is pretty high. If that happens, obviously it impacts the Nifty and the bank Nifty. So till the bank Nifty is above 46,000, I think the chances of the bank Nifty actually moving towards the previous high of 48,500 is pretty high. So there are many heavyweights that are actually batting for the bulls. On the other hand, I can't give you 5, 6, 7 names that can actually pull the market down.
No, absolutely. So just since you mentioned HDFC Bank, take your point on Reliance entirely. It's been the most solid stock for the index. Since you mentioned HDFC Bank, I know we don't get into individual stocks, but do you see sort of the downside ending, or do you see an upside building up over here? I mean, a lot of people are wondering whether this is the time to take that big long trade on HDFC Bank, but they've just had to wait by, and it's not coming, that long trade.
Well, I think it's quite irrelevant. To be honest, there are much better opportunities in the market. It's just that HDFC Bank is the biggest stock in the market, and therefore everyone's invested big time and, to the brim. And that's probably the reason everyone's interested in it. But for us, I think SBI has been the trade of the year. And I think we continue to believe that SBI can actually move towards a level of 1,000 at some point of time this year. So given that kind of a massive move that we expect, I think HDFC Bank will broadly remain in a range, 1380 on the downside, 1550, 1570 on the upside. It's really not going to do much. So in today's market, opportunity cost is huge. So you don't want to really get into stocks like HDFC Bank when there is so much happening and there is no real momentum on the upside.
Okay, all right. Hi Gautam, good morning. Good to see you in. Reliance, that's been the big outperformer. What are the levels you're looking at on Reliance Industries?
Well, Reliance is coming out of 1.5 years of consolidation. So I think longer the consolidation, the bigger the breakout, as they say in technical analysis. And I think it's held down to that level of 2750 really well. I think 3,000 is a psychological number. Once the stock gets there, the market will celebrate it. And I think once past 3,000, you could easily see another 10 to 15% upside, which will obviously have a huge bearing on the entire market. So I think Reliance single-handedly can actually keep the market firm. And if you look at charts of Reliance versus HDFC Bank or Reliance versus the Nifty, you will see that the ratio charts are all picking up. So it's possibly a phase for the next 3, 6, 12 months where Reliance outperforms the entire market.
Got it. PSUs, Gautam, again, it's not a homogeneous group, but everything with the PSU tag to it is done very well. So here, are there any trades to take from here?
There are selective trades, Prashant. The problem with PSUs are that they are overbought, but they're not overvalued. Because all of these stocks started doing well when they were at 5, 6, 7 PE, and now they are pretty much 10, 12, 13 PE. So they're not expensive by any imagination. It's just that they have run up so much that there is this concern that will they correct? But I think even in the PSU space, if you are in the right pocket, say some of the top PSU banks, SBI, BOB, Canara Bank, some of the metal PSU names like Nalco and SAIL, I think you should be safe. Even names like NTPC and ONGC, I do see them as structural stories and continue to do well. So you can't buy anything and everything in PSU anymore. And there is definitely room for some correction in the stocks that have run up very big in the last 6 months. But there are certain pockets which I highlighted where I think the opportunity is immense even now.
Okay. Asking you a bit of a out of syllabus question. The stock on mind is Vodafone Idea. I'm not asking you to predict levels here, Gautam, but I mean, technical analysis tells us that prices always move before the event happens, right? And people are trying to figure out if there's something changing, if there's a bottom that's being formed, if there's a turnaround in the works. But broadly on telecom, if not on Voda Idea, any thoughts here? We've already discussed Reliance, but Bharti, and if indeed you're seeing any sign of life in the charts on a stock like Voda Idea?
Not really, Surabhi. At Goldilocks, we like to stay with grade A. And I think for the last couple of years, Bharti has been our top pick in telecom. It's done exceedingly well. And I think there is a lot more money to be made in Bharti. And now with Reliance joining the party, I don't think I need to really go one notch lower. So I would love to just stay with Bharti and Reliance if I want to play telecom.
Okay, all right. Gautam, what about any levels on the mid-cap to small-cap indices that you're looking at? That's been the party, right? From March 2023 till date, one will look at the Nifty and say, wow, the index has done so well. But if you look at the mid-cap and the small-cap indices, you'll say, well, I wasn't really at the party. That's, blazing all cylinders. Any levels on the mid-cap and the small-cap indices?
Honestly, mid-caps and small-caps are beyond levels because, every single level in the last 6 months have been cleared. The mid-cap, small-cap index has been range-bound in the recent past. I mean, you could see the mid-cap index move towards a 52,000, which is entirely doable. But I don't think it's really reflecting in what's happening in selective stocks. There are two forms of correction in the market. One correction is when it actually falls, and the other correction is when the index turns sideways or range-bound. So in the last 6 to 8 weeks, the mid-cap and small-cap indices have just been range. I think there are very limited opportunities, so you cannot really look at the index and say that the market is up. I think auto ancillary, power, infrastructure, unlock stocks, I think these are pockets where we are more keen on and therefore don't look at the headline indices too much.
Okay, individual stocks that catch your eye. Gautam, what are global markets, particularly US markets, telling you? What's the yield telling you? Because the 10 years back at 4.3, there's been a dramatic, of course, NVIDIA-led rally, all-time high for the indices. But now even, Wall Street has gone into a bit of a pause zone. What are the indications you're picking up there?
Well, I've been a firm believer that India and US have moved hand in hand all along. In fact, if you look at the data since March 2020, our move and the move of the S&P 500 has pretty much been hand in hand. And I think this is going to continue. So when you have strong global markets, I mean, look at European markets, they are all at lifetime highs. Look at US market indices, they're all doing well. And we've had a series of higher tops and higher bottoms. And I still do not see any signs of topping out in the US indices. In fact, the Russell 2000 is coming back very strongly. The NASDAQ still looks good for another 7 to 8%. And the top 7 stocks in the NASDAQ and in the US are still super strong. I mean, look at Amazon, look at Microsoft, NVIDIA, all doing well. So the point is, when you have a positive US market setup, which is still the case, I don't think the Indian market setup can get derailed. And with almost 19,000 crores domestic money coming into the system every month, you need something completely out of the box to derail this market, and therefore it looks difficult.
All right. Gautam, thanks very much for joining us. It's a pleasure having you with us here and getting that perspective from you. I think the market's down, 7 or 8 points. So this is as quiet, Surbi, as it comes. Market breadth is still positive, but the gap has narrowed down quite a bit. I mean, 1,200 stocks are higher and about 950 stocks are lower.
Yeah, I guess it's all about individual stock action. Mazgaon, for instance, is now tracking a 5% gain. There is, Shipping Corporation of India. So, by the way, there's PSU rally, even stocks like MMTC, Hindustan Rectifiers, quite a few, STC, a lot of these government-owned stocks, they're once again popping up on the screen. But the stock that we are going to focus on, the company that we are going to focus on now is KEC International. The company held a conference call recently and it gave out its FY24 order inflow guidance at 20,000 crores. And as of February, the company's order inflow stands at around 14,000 crores. So let's talk about the business outlook, the momentum, and what lies ahead. We have Vimal Kejriwal, Managing Director and CEO at KEC International with us. Mr. Kejriwal, always good to have you on the show. Thanks for joining in. So tell us, as we're entering the last leg of this fiscal, what is the momentum looking like across your business verticals? Because you are a little short of that target of 20,000 that you had put out, but you're confident of achieving it. And if so, tell us where the thrust will come in terms of fresh orders as we're looking at now, the last month of the fiscal year?
So, Surbi, you're right. We are actually significantly short of order intake target. We are at 20,000, we are at 14. But we have roughly L1s of 7,000 crores, of which more than, I think, 2,000 odd are with Power Grid, and there are some other domestic players. And then there are a lot of L1s in the civil. We are reasonably confident that most of them, or virtually all of them, should get converted, and we should be able to, achieve our target of 20,000 crores.
I remember Mr. Kejriwal and the guidance. I mean, have things slowed down a little bit in terms of how they're coming along? Good morning, sir. Prashant here. Because I think back in September, we discussed intake of close to 25,000 crores. And then, of course, the last was about 20,000 crores. And now, as you're saying, you're short, but L1s should convert. Most of them should convert, as you say. But is there a general slowdown, a trend that you're seeing at all?
So, morning, Prashant. I think what has happened is you're right. We were at 22, 23, not 25, but 25 was a very optimistic figure. We had thought we should be able to do it. A few things have changed. I think one is somewhere looking at what's happening in the railways, we have also slowed down a little bit of a focus on railways. Second is private capex has not yet picked up. We had thought we'll get a lot more orders from the private side. So that's something which has a bit slowed down. Thirdly, what has happened is that we also took a stock of our order book and also our cash flows. You know, it's been a little bit of a concern saying what is the debt level and all. So we also started becoming a lot more choosy on the order intake. See, today we have an order book of around 30, 31,000 and 7,000 crores of L1, which takes us to around 38,000. We should be touching a revenue of around 20,000 this year, and maybe let's assume a 15% growth, so 23,000 next year. So we are reasonably okay with our order book for next year's revenue also, and that's why we also started becoming a lot more, I'll say, quality conscious in our order intake. And that has also had a marginal impact on our order intake in L1.
Okay. Mr. Kejriwal, you said slowed down the focus on railways a little bit. Can you explain that?
So railways, what has happened is that we are seeing a significant delay in implementation of many of the infrastructure projects, and also a little bit of cash flow issues for whatever reason. So because of that, I think we have gone a bit slow. And I think what is also seen is that the railway focus right now has been more on, new trains, station rebuilding, etc. And the number of on the infra side, that's new tracks, and all that has been slightly lower. The second piece is the competitive intensity has increased significantly because I think there are lesser tenders in roads. So most of the road EPC players have moved into railways, so which is impacting the margins of the new tender. So I think we have become a bit cautious on the railway side.
Mm-hmm. Okay, all right. Hi, Mr. Kejriwal. Good morning. So we've got a broad outlook in terms of revenue growth, in terms of order inflow, and you're optimistic that you'll get to that number. Let's talk about margins and the working capital days. The last time we chatted, you were telling us that you're expecting margins to gradually improve. I think you're guiding for around 7% for Q4. And gradually it'll move to double digits. So could you tell us by when does it move to double digits? I think 10% we were talking about in FY26. Do you think it can get sooner? And what about working capital days? Give us a broad guidance.
So Nigel, if you look at the numbers, our Q3 margins for 160 basis points, year on year ago. We have been talking about 7. I don't think we'll be able to reach 7, maybe a little bit lower than 7. We should be, for the year, should be around 6.5. I think that the major reason is there is some slowdown in terms of our revenue because of the major issue is the supply chain and the Red Sea issue. So we have slowed down on some of our supplies to Europe and to Saudi, etc., because the freight rates have gone up like anything, and we don't need to necessarily do that supply right now. So maybe that part will probably move into Q1 next year. And since those are largely the new orders and they have a higher margin, there may be a marginal impact on the margins for the quarter, but I think that will make up. Next year, we have been talking about, for the year, doing anywhere between 7.5 to 8% with an exit of close to double digit next year end. I think that's the numbers which we are going out on the margins. And as far as working capital is concerned, I think we did show a reduction in Q3, and we are very confident that again in Q4, we'll probably bring down a debt by around 300 or maybe 500 crores is our internal target, and could bring down the debt by 500 crores. So I think we are moving in the right direction on the margin as well as on the debt reduction.
Okay, so just a word on how you plan to reach that level of 7.5%. What will be the kicker? Will it be the mix that changes? Or will it be something else, some of the supply chain issues going away in the international business? And a word on the top line as well, sir, because you're confident that you should end the year with a 20,000 crore rupee order book target. Now, in terms of revenue growth, FY24 looking at 25, what's the top line growth estimation that one can work with when it comes to executing the order book?
So FY25, our top line target is around 23,000. So we are expecting that we'll close the year at around 20,000 this year, and there will be another 15% growth for next year. That's the way we look at the top line. As far as the margin improvement is concerned, I think the new orders are coming at a decent margin. And also the major reason for this increase is going to be the closure of the legacy orders. We have been able to close most of the legacy orders. Whatever else are there, maybe this quarter, maybe at the most Q1 next year, we should be out of all the low margin orders. So the major reason is going to be the closure of old orders and execution of new orders.
No, absolutely. So I remember you mentioned this in an interview to us even in December 23 that your newer orders apparently are coming at margins of as high as 10%, if not more. Are these in the T&D segment? Is that the major margin accretive segment for you?
Most of it is in the T&D sector. In fact, if you look at our, we don't give out those many numbers, but if you look at our T&D India order intake plus L1 this year, FY24, we should be higher than 6,000 crores. I don't think we have ever seen order intake of 6,000 crores plus in the India T&D. And beyond that, I think we have around 30,000 crores of tender pipeline, either quoted or to be quoted in India. So I think that's one of the major reasons for our confidence on the numbers, across revenue or margins.
The fresh lines to be put up, Mr. Kejriwal, because I remember asking you this on the T&D side, and you said that at that point, 6 or 7 months back, that it's not new lines, but existing lines to be put together and made good again. But these are new lines. It's a large pipeline.
So Prashant, these are two different issues. One is, there were many plants which were operating at 50-60%, and with the PLF factor and with the power shortages happening, I think most of these plants were pushed. So that's where we got involved in strengthening. But all these are majorly new lines, and I'll say almost 90% or maybe even 100% are for offtake of renewables from Rajasthan and Gujarat. Two states where we are having the maximum work, and I think a little bit happening in the Karnataka side also. But largely, I'll say 90% of our order book is right now from Rajasthan and Gujarat for renewables.
Okay. Got it. And you're saying that tenders and visibility of tenders in that segment is about 30,000 crores, right? Projects already put together, and where there's more so both of that 30,000 crores, which should get awarded out in the next. And any visibility of how much? What would your take be out of this number?
So Prashant, I think we'll have to keep our fingers crossed, because I think the day the elections and all get announced, if some of them get finalized before that, we should have them now. Otherwise, I think we'll have to wait for end of May or something. But most of these are already announced standards, so we are keeping our fingers crossed. And I think I've been watching our channel for the last 2-3 days. We have been seeing, so many of our competitors, vendors are getting orders from Power Grid. So I do see that, there is some fast tracking of release of orders.
Okay, got it. And I mean, once the sort of model code of conduct kicks in, formal government tendering work will stop, and then of course restart later. We'll see, but great conversation. Sorry, yes.
Sorry, one more point on this model code of conduct. What we have also seen many times is if the projects are critical, the utilities and all have been going to the election commission and taking approvals to issue orders. So it's not that it stops completely. If it's urgent, they can still get approvals if they want to do it. Okay.
Oh, wonderful. The way it should be. Thank you very much, Mr. Kejriwal. Great conversation, and I think you really provide a sort of very nice sort of view of what's happening in each of these sort of businesses and a bird's eye perspective, which is very useful. Thank you very much for joining us.
Thanks for having me.
With the conversation. All right. So that's KEC International. Stock, by the way, has jumped up to the day's high. It's up about 4.5% as things stand right now. We are up 13 points, so it's still flattish, but up a little bit, 22,200 plus. We'll take a break here. We are back. And we'll be joined by Mr. S.K. Jha, Chairman and Managing Director at Mishra Dhatu Nigam, to discuss their business outlook, plans going forward. Stay with us.
Welcome back. Well, let's focus on Mishra Dhatu Nigam. Well, the stock in the last 1 year or so, it's been a big outperformer. The stock is close to have doubled. However, in the last 1 month or so, the stock has got a little bit nervous. From early February, last 12 months, beautiful. Last 1 month, the stock has come down, I think, close to around 20% from its recent high. But to understand what's the way ahead, well, and to help us out with what's the current positioning of the order book, we're joined by Dr. Jha, the chairman and managing director of the company. Hi, sir. Morning, and good to see you, and thanks so much for joining in. Well, let's focus first on execution. We've got your rough order book, and we could get an updated number. But at the start of the year, I recall you telling us that you're expecting to grow by close to around 20% in FY24. As of the 9 months, well, you have done more than that. You've done close to around 27%. But you also said you expected margins to go closer to around that 30% odd mark. In the last quarter, there was a dip. For the year, what is the average margins, and what is the revenue growth we should look at both in this year as well as in FY25? Please go ahead, sir.
Yeah, first of all, this year we have a very big change in our the business areas. Mainly because now we are mostly serving the high-end materials, that is of nickel-based alloys, which requires a lot of other valuable metals like molybdenum, cobalt, niobium, and other precious metals. And these prices are fluctuating in the international market. I think the main reason on pressure on our profit is because of variation in the raw material prices. However, recently I have seen in the last 3 months it has come down. It is getting stabilized. I think this will have the impact we'll see in the Q4 or maybe in the first quarter of the next financial year. Both will have the impact. We'll have the better improvement in our margin because of that.
Okay.
Regarding the growth, as you have already told that we have already crossed almost more than 25% if you see the last 9 month operations. And of course, Q4 has been always good for the company. So I expect that we'll be maintaining the similar level of growth in the revenue and in terms of the value of production also.
Okay.
Regarding,
Yes, sir. So Mr. Jha, I just wanted some more clarity. So this year you'll end closer to around 1,100 crores of revenues?
We are targeting 1,100 crores.
1,100 crores.
This year. And
on that base, you will grow another 20%. So you'll be closer to around that 1,350 crores approximately for the next year.
Yeah. True.
Got it. And what about the margin outlook? The worst is behind. You're seeing the raw material cost has cooled off. So margins will improve from here on. On an average, what should the range we should work with?
If you see now, the margin which we are operating in the last 9 months, if you see, there is a lot of pressure in the margin, but I see the last quarter will have the better realization of that profit because the whatever raw material we have consumed so far, I think those things are only going to give the output in the next another 1 month left now for the completing this financial year. So I am sure that will have the better performance, but then definitely it is not going to go near about 30 or 30 plus. I am just saying that it will be in the range of 20 to 25%. In that range only the margin will be there overall for this year, current financial year.
All right, 20 to 20. Sorry, go on, please, sir.
And why it is so? Because mainly now we are serving the high-end materials for the aerospace industry, and aerospace industry requires all mostly the nickel-based alloys, then titanium alloys. And you know that the raw material prices across the globe, it has gone up, and supply chain also got affected. So because of that only this is coming, but I think we are in a position to stabilize it further as we progress.
Mr. Jha, hi, good morning. Prashant here. Could you tell us, just talk to us a little bit about the order book and what is really the scope of the orders? It's a sector which is taking off. The government was the primary sort of player in the field. There are so many sort of private entities which are coming up really fast. There is the recent FDI news. What is the sort of size of the market as you see it for you, sir? How do you scope it?
As I have told earlier that we are targeting more than 25%, 20-25% growth year after year. So definitely our order book also has to grow in similar way. And if you see today, we are almost crossed almost 1700 crores plus. We have the order book position. But there are good indications. I think this year we are almost finishing the total order booking will be by the last quarter. It will be coming to almost 1500 crores for this year itself order booking. So and it is not only that order is not available. Many orders we are not able to take as on today because of capacity constraints, and also the supply time is very less for the mostly for the overseas companies, because now they are approaching to us, or and for that matter other companies in India also, to get the raw material at the very in the very less time. So that part we have to address now, and I am sure that we have also addressed it. That's why this year our export is also going to touch the maximum level, and I am expecting that this will further grow in the next year, because a lot of indications, positive indications are there, and we are interacting with the many leading aerospace companies of the world, and I am sure that will further give us the advantage for whatever we have.
Absolutely, sir. Absolutely, and the company always comes into the limelight when we have these high-profile space missions, especially. And just yesterday, when we had the 4 astronaut names get announced for the Gaganyaan mission as well, so extremely prestigious projects, all of these. But can you give us a mix between the space and the defense revenue? And is there any difference in margins, or are margins pretty similar across both the businesses? Because you're saying 20-25% EBITDA margin for the next year, by the end of this year. What should we expect on the margin profile, and what will be the revenue mix in this 1100 odd crores for FY24?
Yeah, in FY24 we'll be almost doing the defense will be the maximum. We'll be completing defense with almost 60 to 65% defense supply will be there, and space will be around 25%, and the balance will be the rest. What happened in the space, whatever orders we have received 2-3 years back, already we are completing, almost we have completed 90% out of that. So unless we get the new orders coming from because now the space is going for the transformation, that they are going to go outsource, and also the many private players are coming into the picture. So those things, the finalization of the contract is taking some time. So definitely, once this gets finalized, then we'll be also going to the fray to get the orders from that type of consortium. But I have seen that now that change, that also if it is coming to the place, the margin which we are operating today, probably we have to also be in the competitive mode, where many, as you rightly told, that many companies are also coming in this area. So definitely there is a pressure on the margin, because we cannot operate on the higher margin for that also. What we have to see that we have, with our enhanced capacity, we have to increase the volume, and we have to also see the cater the requirement of the defense, especially in the aerospace sectors, for the Indian requirement and the foreign requirements also. So this is the combination where we have to work, and then see that how we can best maintain our margin the best possible way. But definitely it is a very challenging market, very competitive market. But since Midhani is having a special, unique placed in this sector, so definitely we'll have the advantage in getting the new orders coming from the different sources.
Got it. Good sector, but it's getting competitive. We got that. Mr. Jha, final question before we let you go. You're talking about capacity constraints, but also you had some kind of, I think, debottlenecking, some capacity coming on stream. So at peak capacity, with your current gross block, what kind of revenues can you do? Point number 1. And point number 2, we normally ask you about this. Have you heard something from DIPAM? Is there going to be an OFS in Midhani in the next 1 month or so? Because FY24 we were talking about, it's almost the end.
First, I'll address on the capacity wise. We are a continuous, means like a plan to enhance our capacity, both on the upstream and downstream. That is regularly we are doing. So that is giving us the advantage for the getting the bigger volume from the market, from our sales. And also for regarding the OFS, in fact, the DIPAM is the right agency to comment on this, but we are already, this was indicated long back, they will go for OFS, but now I think they are likely to finish maybe in the 1 year, but I have not heard a concrete plan so far from the DIPAM as of now.
Okay, all right, Mr. Jha, we'll leave it on that note. Thank you very much for sharing all the details on the business with us. Good chatting with you this morning, and all the best for your plans.
So, we just one thing, Mr. Jha was talking
Prashant
about...
is here, he's not going up to space.
I mean, for those who don't know, Gaganyaan, one of the astronauts, right? The first sort of manned mission, right? Is Prashant Nair.
Yes. Oh, I didn't realize the surname as well was now. Okay.
So in the evening, I think I got lots of messages and saying...
All the best, congratulations.
You know, and if you didn't check your phone, you'll be wondering, because people are saying, Prashant's going to space. So I said, no, he's in the studio tomorrow. So they're like, oh, okay.
Very glad to have this Prashant Nair right next to us.
From space. But I mean, it's an incredible moment in that sense, of course, for the astronauts. And so that's really something to be proud of. And we wish, the team all the best as they embark on that mission. So that's, what we're looking at. 10 points lower on the Nifty. Let's focus on an exclusive conversation now. This is Jesper Brodin, CEO of Ikea, saying that they will decide on the next phase of India investment before the end of 2024. In a conversation with my colleague Shireen Ban, Mr. Brodin talks about the upcoming stores in India and, of course, the investment plans here going forward. Listen in.
Let's talk about the view on India. And I know you have, of course, been long-term committed investors to India, but you also need to have a lot of patience, as you keep saying, to stay committed and invested in India. You've just returned from visiting your Gurgaon facility, which is still in the works. It's work in progress. What's the status on that?
The status is, it looks good. We are basically deep in construction right now. And the Ikea store will be, as quite often these days, not only an Ikea store, it's going to be a shopping center, and there will be some other facilities as well. So that means it's a quite complicated and big project for us. But as we are in Ikea, we try to think long term. We try to think about not just being here for the short term when it comes to driving our business, but actually establish ourselves for decades and a long period ahead. And I can tell you a fun story, actually. One of the last times I met our founder, who passed away a few years ago, as an old successful entrepreneur, I asked him about the future, and I asked him, how should we think about the future, Ingvar? He said, you should think long term. And then I asked him, how long term? And he said, 200 years, he said. But I can promise you, we're going to open Delhi before 200 years.
Well, I would certainly hope so. But, so you've got Gurgaon coming up, Noida still a couple of years away from being ready for operation. And Delhi, no plans yet?
So basically, in the Greater Delhi, we are looking at actually doing what we have rarely done before. We're going to open online first. So we are deep in preparations now for logistics, digital capacity to actually open our online experience first. And then the store will come in maybe 1.5 years or thereabouts, I think. And as we then progress with Noida, we're looking into other sites and opportunities in Delhi. To this date, we don't have more to share, but I think my team will probably be able to respond to you before I meet you in the snow next time.
So by 2030, because we're talking long term, not 200 years, but a couple of years out, how large is the Ikea presence likely to be in India?
Well, it is what we are basically working with right now. The first chapter for us was to build the first store, which has, as you know, opened some 5.5 years ago in Hyderabad. That was to prove to ourselves we could, and that there was a market and there was an interest. And you can say the experience has been phenomenal for us. The interest is massive. After that, we opened in Mumbai, Bengaluru, and now Delhi is on the map. But the long-term plan for us is to establish Ikea in all big cities and then expand in an omnichannel context in India so we can reach as many people as possible. We are, you can say, on one hand, we have to be a bit patient because building big Ikea stores takes a bit of time. Building industry capabilities for the volumes that Ikea is supporting is basically a game of not only supporting Ikea, but making sure there are entrepreneurs, investors. There is export as part of it, because in the beginning we need to build volumes where we rely a bit on export before it can benefit the domestic market. Normally it takes a decade or thereabout to get all of these things in place. But we are truly, on the other hand, in a hurry to build those volumes so that we can reach more people and also work the economy of scale to bring even more affordability to people.
You know, you talked about your big stores, but let's talk about the experiment with the small store. And
Yes.
you have decided now to close the RCD store in Mumbai and consolidate
Yes.
your operations. Explain to me why you felt the need to do that. Was it an experiment that didn't work out, obviously, as per your expectations? Are you giving up on the small store format plan? What's the story there?
Yep, the story is, so basically we have concluded that the small stores will be part of the IKEA concept as we see it. We started the project around 2018, I think, when we said we need to experiment not only with online services, but also how do we bring IKEA closer to the city centers. And the analysis wasn't that difficult to understand. A lot of people, limited capacity to move to the outskirts of the city. So we wanted to bring the physical experience to people in a smaller format then. I think we have done probably about 40, 50 of those. I think we might have closed some 10 of them. Typically, we learned that we need to be in prime location. We need to also build it in a certain flow so that it enables for people to find what they need to find. And the Mumbai store that we recently closed was one of those where we basically weren't in a hot spot enough. So I wouldn't say, you know, these smaller stores are quite, they are smaller decisions for us because, of course, the investments is very small compared to Noida and Gurugram. But I'm sure that we're going to continue to find ways also in India to establish smaller stores.
So you're not giving up on the small store strategy?
No. But I'm also open to test and try, which means also in the future we might say that didn't work. That's part of being an entrepreneur. So hopefully we will test and try many more things here. And part of that will be sometimes we have to give up and say that didn't work.
So by when do you think you'll be ready to make the announcement or be clear about the next leg of your investments?
So unfortunately, time is up now. No, I can promise you that my team will come back to you within this year, at least. And then I'm conservative to say, here are the new numbers that we are willing to share. Again, we have a couple of discussion points with officials and with representatives of governments to make sure that we gain enough confidence to say we are ready to take the next step of investment.
Is it likely to be the same number that you replicate or higher given the experience that or the consumption story that you see?
I promise you it's a number you will like.
It's a number.
More than that I can't say.
Okay, but within 2024 is when you will make the decision about the next phase of investment.
We will do so.
All right, well, 10 points lower is what we have on the Nifty. We're at 22,190. Mitesh is with us on the program now with what he's making of the action so far. Mitesh, hi, good morning. 6 points lower is absolutely flat. Any trades you'd want viewers to put on?
Prashant, nothing on the index. I think, as I said, with the volatility indicators turning down, I think you might see the choppy consolidation kind of become slightly quieter. But broadly, it is still a market which is sideways. So trading should be more stock specific. I have a buy on Tata Consumer. I think, that's a stock which is breaking into fresh highs, showing good momentum. So keep a stop below levels of 1180 here and look for targets of 1245. And amongst the paid names, I think Berger is giving a fresh breakdown. So that's a sell with a stop at 567 for targets of 535.
Okay. All right. Thanks a lot for that, Mitesh. Well, let's focus on one stock, which is Shriram Finance. Now, year to date, the stock has done very, very well. It's been off the blocks in style. As we've been mentioning, fundamentally, it has some kind of support because valuation-wise, it's trading at around 1.5, 1.6 times price to book, and it's cheaper in comparison to its peers, and it's got some kind of cushion in terms of margins. That's the fundamental part. The second part that the street was waiting for is the technical part. And that was with regard to it coming into the Nifty. Let's give you a quick background now. The NSE Index Changes meeting is scheduled today as their Index Maintenance Subcommittee of NSE Indices, well, they decide on the changes and they'll make an announcement on the changes post-market hours. The consensus expected Shriram Finance to come into the Nifty while UPL will move out. But from yesterday, suddenly the street is a little bit nervous on Shriram's Nifty inclusion. Why is that? Two broad factors. One is Zomato as well as Avenue Supermarts. Well, they are eligible as per the current criteria, but both are not F&O stocks. So that's one point why it's a little bit nervous. And the second factor is, in case there is any kind of significant methodology change in the computation of inclusion. So that's anyone's guess, in terms of what they could potentially do. So at current reckoning, going by the past data's performance, you take the market capitalization, Shriram Transport, well, it fits the bill. But if there is any kind of change in the methodology, that's what's making the street a little bit nervous. So post-market hours will know, but these are the two factors that are making the street a little bit nervous.
All right, Nigel, thanks very much. Interesting explanation in terms of what's happening there. We'll take a quick commercial break here. Manisha will put the focus on commodity markets when we come back in just a bit. All right, welcome back. We got the markets, which are absolutely flat, up a little bit now, 25 points or so. Let's shift attention to the commodity space. Manisha is here with what she's tracking today. Manisha, morning.
Morning, Prashant. I'm looking at copper because this is a commodity, and a Dr. Copper, as it's known, has been sold in the last 3 or 4 sessions. But we've seen some bargain buying happen on the lower side. This also is happening as the futures markets are higher ahead of the expiry, which is due today. Well, there also is funds short covering because we have been looking at very short positions being created by investment managers and funds in many of these metals, including copper. So there is some short covering as well happening there. All of this is happening ahead of the China PMI data. That is one thing that is awaited. And the other is the China National People Congress meeting. That's happening in this week as well. And the expectation that you could be looking at a long-term vision coming in for the property sector. You could also be looking at some stimulus measures coming in, some more pledges in sense of supporting the property sector, etc. And that is where the metal is taking some sense from. Also, when you look at the China copper ore and concentrate imports, that has gone up by nearly 20% versus the first quarter of 2021. This is before the property sector started to see a decline. Also, when you look at the inventories in Shanghai itself, that has gained up by 500% year to date right now. Of course, the inventories were on the lower side in the previous year. We were trading in a deficit when it came to copper for the last 3 years. So this is support coming in from very lower levels in sense of those numbers there. But there have been also very interesting statements coming in from the global banks and brokerages. To begin with, Goldman Sachs says that the largest immediate price boost in commodities would come in copper when the US rate cuts actually happen. They've actually put a number out at 6% of an immediate reaction on the higher side, as and when you start seeing those rate cuts come in. There also is a report from International Copper Study Group which says that the world mine production will increase by 3.7% in this year, but they expect the consumption to be much on the higher side. ANZ also came out with a report on copper saying that the demand growth in 2024 from US, China and India is anticipated 4.3% year-on-year for the year 2024. ANZ also puts the copper price estimates at around $9,000 this year and $10,000 in next 12 months. Currently, the copper prices are trading at an $8,400 per ton. There also is a report from Citi which says that the copper prices could reach $8,800 in the coming 3 months itself. So bullish cues coming in from the banks and brokerages as well. I quickly want to touch upon the copper smelter charges, where we have seen those decline to decade lows. That is because the concentrate is easily available. There is more production. The contango seems to be getting deeper. So that tells you that immediate availability in sense of copper is on the higher side there. When you look at the spot treatment charges, they are at $19. It is 9% lower than previous year at $80 a ton. And we also are looking at these numbers at much lower than a 6-year highs that we saw in 2023 as well. So immediate availability is there. But going forward in the second half, the expectation is that the copper demand is going to be much on the higher side.
All right, Manisha, thanks very much for that. Well, we'll take a quick commercial break here. Our special segment, It's the Economy, comes up next with Lata. We'll get chatting with Nikhil Negania of Bernstein and Girish Kumar Kadam of ICRA. And they put the focus on the power space and discuss government raising the forecast for power demand over the next couple of years. Stay tuned.
Welcome to It's the Economy. Our focus is on the power sector. The government has upped its forecasts of power demand by the year 2032 to 384 gigawatts. That's up 5% from a previous forecast. Given that the peak power demand in the current year was or is about 244 gigawatts, the government is expecting demand to rise by a compounded annual growth rate of 6% over the next 8 years. That will mean commensurate increase in transmission and distribution capacities too. The market has already been rewarding power stocks from Power Grid to NTPC to Tata Power to Adani Power, SJVN, GE, T&D. Look at the stocks. It's running for you. They have risen between 80 and 800% in the past 1 year. With the government upping its power demand forecasts even more, is there more juice left in power stocks? And if yes, which stocks or sectors? Or can the old nightmare of the power sector, Discom overdues, return to run down the fortunes of power stocks? For all these questions, I have with me two experts. I have Nikhil Nigania, the Director Senior Analyst at Bernstein, and Girish Kumar Kadam, Senior Vice President and Group Head Corporate Ratings at ICRA. Gentlemen, good morning and thank you very much indeed for your time. Nikhil, first of all, the math is not kind of convincing. This year, the Power Ministry tells us that demand has risen by 12.7%. And they've upped their forecast only at a 6% CAGR for the next 8 years. Will this be inadequate? How do you make sense of this?
Thanks for having me on the show, Lata. So, see, in terms of power demand, structurally for developing countries, the power demand tends to grow at about 1x of the GDP growth rate. That's a long-term forecast that one typically takes, plus minus maybe 0.8x GDP to 1.1x GDP. That is the range it stays in. Near-term variations do happen, largely due to weather patterns. So last year, for example, was very warm, which led to very higher power demand growth rates, especially in select months like August, September, October. But that's not something we can extrapolate to future years. So from a longer term perspective, the demand growth forecast of 6% CAGR actually looks realistic. We don't see it being beyond that point. Unless...
Oh, no, thanks for enlightening on that point, that it has to be 1x GDP. And then it makes sense if it is, between 6 and 7% annual rate. Girish, how does one fill this gap? 140 gigawatts need to be added. And the government, again, I'm going to the Power Ministry's presentation, we have added only about 10 gigawatts this year. Going by this logic, we have to add 14 gigawatts or even more, I think 16 gigawatts every year. Is it inevitable that we have to do thermal? How do you see this this demand being met?
Yeah, thanks, Lata. So thanks to the the robust energy demand growth that we are witnessing, clearly we are seeing uptick in the thermal PLF levels. In fact, the government has revived the focus on incremental thermal capacity addition in the near to medium term. In fact, based on our estimates, there is a clear need for incremental thermal capacity addition, over the next 5 to 6 year period. We see that assuming the energy demand growth remains at least 6% or closer to 7%, there is a clear need of incremental thermal capacity addition of about 30 to 35 gigawatt, which is over and above the under construction thermal capacity which a sector has, which is anywhere between 25 to 27 gigawatt. So certainly there is a need for incremental thermal capacity addition, and which is why the government has revived the focus. Okay. That's number one. Number two, the incremental, power generating capacity addition will continue to be driven by the renewable energy segment. Now, within the renewable energy segment, the solar segment will continue to be the main driver. And in fact, we are expecting the large capacity addition in the renewable energy segment, anywhere close to 23 to 25 gigawatt to start with next year. This year, we are expecting anywhere between 18 to 20 gigawatt of renewable capacity addition. And going forward, the run rate in terms of the renewable energy capacity addition is required to be well above 25 or to the extent of 30 gigawatt every year. In fact, the targets are pretty ambitious, and they require closer to 40 gigawatt of the renewable energy capacity addition requirement to meet the policy target of 500 gigawatt cumulatively by 2030. So there are two limited points. One is there is a clear need for the incremental thermal capacity addition. On top of that, because of the policy focus and the kind of tariff competitiveness which renewable sector has already achieved, we are expecting and we would expect a sizable renewable energy capacity addition to happen over the next 5 to 7 years. So with that,
okay, got that. Girish, I'm trying to pack in more, so let me come back to you for more.
That should fill the supply.
Now, Nikhil, what is the, who are the beneficiaries likely to be? Your own list of recommended stocks is only 4 of them: Power Grid, NTPC, Renew Power and Adani Green. And of that, one of them you have as underperformed, Adani Green. So, clearly this mantle has to be borne by a lot more companies. Which sectors, if you don't want to name names, will be the beneficiaries?
For sure. So if you look at the beneficiaries, we could cut them into 3. One are obviously the utility names like NTPC and Power Grid, which we continue to like. Power Grid we initiated just last week with an outperform rating, which we see as a beneficiary of the transmission capex need. The second bucket of beneficiaries are the equipment suppliers, some of which you were alluding to earlier. Especially the transmission equipment suppliers, where it's not just a domestic theme, it's a global theme, where transmission is becoming incrementally critical for addition of the renewable capacity needed. And the third bucket of beneficiaries are the power financing names. Power financing also, the sector had a very bad phase the last decade, but given the quantum of capex needed for both energy transition and also meeting the non-solar hour power demand with thermal capacity addition, etc., the capex need is going to be gigantic. And hence, power financing companies should see stronger loan book growth with lesser risk of NPAs, given largely incremental capacity is renewable, where you have power purchase agreements. So, so these 3 buckets, utilities, equipment supplier, and power financing names are the key beneficiary.
Okay. Let me take power finance. You don't have coverage at the moment. Can I expect that there will be more and more coverage of power finance and power equipment companies, even from Bernstein, because by your own admission, those will be the beneficiaries?
Hard for us to say in terms of coverage, but in terms of thematic, without a doubt, transmission equipment supplies, we think is, they'll see massive demand come in, both from India and abroad. And same with the case of power financing. They are less covered names. I think they fall between the cracks between power analyst and financial analyst. But yeah.
No, I take your point. I have the financier analyst also with me. So let me ask Girish. Girish, do you see power finance names, PFC and REC, being, faced with a lot greater demand? And more importantly, this Achilles heel of the power finance companies, discom dues, you think that will not come back to bite them? It's just that the cycle is positive now, but who is to say it won't get worse?
So, Lata, would be difficult for me to comment on individual companies, as we do not. Yes. But in terms of discom dues, we have already seen the significant correction in discom dues, thanks to, the implementation of the late payment surcharge scheme over the last 1 year. So the legacy dues are getting corrected in a timely manner through EMIs, and even the regular payments by the discoms to the GenCos and the other beneficiaries are happening more or less in a timely manner, thanks to LPS scheme. The question is to how long it remains sustained going forward. And from that standpoint, what is really required is the fundamental improvement, the fundamental cash flow improvement for the state-owned discoms, because majority of the state-owned discoms, continue to struggle with structural issues in terms of, the inadequate tariffs, higher than approved, AT&C loss levels, higher than approved cost overheads, and also subsidy related gaps. So these are the fundamental issues. So that's where, the reform measures implementation by the state governments and also by the state discoms proactively is required. Yeah.
Okay, but that's not forthcoming to that extent. I take your point that late payment surcharge has created a big difference in the behavior of discoms. But is it big enough, Nikhil? I was just looking at the finances of PFC and REC. PFC's exposure to discoms has gone up from 30% to 34%. So it's just that the discoms appear to have been able to meet the requirements because of not so much RDSS, but more late payment surcharge, only by taking more loans. It's just that the bomb is now sitting with the financiers. Are you really convinced that this will not come back to bite? And this is a very important question for people who have already invested. Like I told you, the past stocks have gone up by 80 to 800%. So you think this will not come back to bite? Nikhil?
Yeah. So coming on the discom side, so you're right. So in terms of the lenders, especially, a massive exposure is towards the discoms. But on the discom side, I think one thing which is fundamentally different from the last power cycle which we saw is how active a role a central government is playing in this case. So power, while it's a concurrent subject as per the constitution, the central government has been very clear, even in the RDSS scheme, for example. So funds being given to the states are not just in lieu of, to spend, but there's a very clear milestone attached. So only if you meet those milestones of loss reduction, of reducing your gap between cost of supply and revenue realized, will those funds be dispersed. So the central government, I think, has done a brilliant job from that perspective in making the discoms move towards a better balance sheet and even raising tariffs if needed to reduce the gap for that part. So hence, we see it improving only from a discom side. Plus, from a PFC side, it's a government-to-government loan. Yeah.
Okay. No, I'm sorry, I'm being warned that I'm out of time. So very quick questions to you, Nikhil. You've got the PFC part, the power grid part right. You initiated coverage saying the capex will be higher than the consensus forecast, and the government's forecast is adding to your argument. So, where do you see the best gains coming in? Will it be in a transmission company, or will it be more in equipment companies? And secondly, yesterday we happened to speak to the NTPC gentleman in charge of renewable, and they seem hell-bent on spinning it off and doing an IPO for their renewable piece. You're against it. So comments on both.
Sure. So let me address the second question first, probably. So we have been vocal that listing the renewable business separately is not a great idea. We have seen it happen in Europe, where 4 companies listed the renewable business separately, like Iberdrola, etc., where they had to take it back eventually. A key reason for that is also because renewable is super capex intensive, and coal business or the thermal business for NTPC is a cash generating part. So if you separate them out, it's not an ideal situation to be in, where renewable will need all the funds for capex and thermal will be generating all the funds. So it's not something we are very positive on. And to the first question you had, Lata, so who gains more? Is it the utilities or the equipment suppliers? Our preference, given our coverage of utilities, we continue to like Power Grid. So from a stock perspective, that's something we are positive on. But equipment, I can't deny. It's a shorter cycle, so they gain faster. So they should see a EBITDA margin expansion. And
which explains the 800% rise that GET&D has seen. And even I think transformers and distributors has seen a fairly substantial gain. BHL is in the league for other reasons. So yes, equipment guys are up there. In not adequate time at all to do justice to a sector like this. I hope I'll be able to get both of you again for a half-hour show on the power sector. Thank you very much, Nikhil and Girish, for adding to our understanding of power sector and power stocks. That's it on this edition of It's the Economy. After a break, Chartbusters.